Hey everyone, Daniel Snyder from Seeking Alpha. Thanks for joining us for this webinar. We are going to be diving into conversation today with Samuel Smith, going through yield versus risk, as well as some of the metrics and certain areas of the market that he is looking at right now, and two stock picks that he's bringing to us today. But before we get into all of that, let's go ahead and knock out our legal disclaimer. Past performance is no guarantee of future results. Any views or opinions expressed in the webinar do not reflect those of Seeking Alpha as a whole. Seeking Alpha does not take account of your objectives or your financial situation and does not offer any personalized investment advice. Seeking Alpha is not a licensed securities dealer, broker, U.S. investment advisor, or investment bank. Information provided by the investing group does not constitute investing advice. Investing group leaders are third-party authors that include both professional investors and individual investors who may not be licensed or certified by any institute or regulatory body. Any content and tools on the platform are offered for information purposes only. Now, with that out of the way, I'm going to go ahead and ask for Samuel Smith to come and join us. He is the investing group leader from High Yield Investor, a service found here on Seeking Alpha. Samuel, thanks for taking the time to talk to us today.
Yeah, great to be with you.
So I like to kick things off. Not everybody's familiar about who you are, how you got into this space, and why you focus on yield and built this platform that we're talking about here today. So can you give us kind of like the quick run-up summary? How did you get into finance? How did you get into investing and where we are today?
Yeah, so I've always been interested in investing ever since I was a little kid. Go to my grandfather's house and watch CNBC with him every morning while eating breakfast. But I really got into investing. Well, I mean, I personally investing even when I was in college a while ago now, but did a lot of personal investing, developed my own investing strategy. And then I finally came across Seeking Alpha back in, I believe, 2017 and started reading articles and decided to submit one of my own and kind of got addicted to that and just started writing regularly. Then I was approached by a couple of investing groups and started writing for them. And I also started writing as a freelance analyst for a third-party dividend investing website and actually became their lead analyst. I was working in engineering at the time and switched over to doing that full time. And then I eventually got to a point where I'm Seeking Alpha in 2020, coming out of COVID. I've always focused on the dividend space, and I saw a lot of really good opportunities there where I felt like the market was ignoring a lot of really great investing opportunities. And so I talked with Seeking Alpha and was able to launch my own investing group, High Yield Investor, in late 2020. And the service has done really well. We've been blessed with really good performance. My thesis turned out to be correct on those stocks. And the rest, as they say, is history. I love it. I spend all my day doing it. Really a 24/7 passion for me.
Yeah. So, but why? What was the attractiveness to high yield? Right? That specific area, because I mean, especially younger, you're always thinking about, okay, well, I've got time for growth. Let's go growth stocks. Everybody wants to go growth, but you're so focused on yield. Why did you pick yield?
Yeah, a couple of reasons. One is Warren Buffett is one of my, big gurus that I've loved reading about, listening to his interviews, reading his letters and his wisdom. And he always emphasized the idea of circle of competence, knowing what you invest in. I've studied the Intelligent Investor book and some others like that. And so when you invest in dividend stocks, you're getting a large portion of your return from the dividend itself. And dividends, especially if you're focusing on quality and sustainability, which we'll get into in a little bit, that's a return that you can really count on through thick and thin. And then you don't need to get superhero-like growth on top of that to still get an attractive return. And so that alone is good. And on top of that, because you're not trying to figure out if, Palantir, for example, is going to be able to sustain a 35, 40% revenue CAGR a decade from now to justify its current valuation, you're just looking at a dividend stock that pays, say, 5-7% yield. You just need it to be able to sustain 3 to 5% growth rate for the next several years to really justify the valuation. So it's much greater degree of certainty. Also, dividend stocks tend to be much simpler businesses. And so that's the idea of circle of competence, understanding what you're investing in. And so basically, I feel like I'm better able to understand what I'm investing in, better able to value it more accurately. And then if held within a tax advantage account, which is where I hold the vast majority of my investments in a Roth, I can then sell and buy securities without worrying about the tax consequences to accelerate the compounding process. Because I have a much higher degree of confidence in what a stock is worth, I can feel confident that, hey, I'm not selling it, ridiculously too early. or I can feel really confident, hey, I'm not chasing a stock higher at a bubble-like valuation, so fewer mistakes, and then the compounding process can make up for, say, only a 15% annualized rate of return or 10%, and can turn that into closer to 15 to 20% annualized rate of return. And I end up getting results that, for example, a high yield investor since 2020, since our launch, we've beaten the S&P 500 over that time, despite the S&P 500 obviously being in a major bull market due to the AI boom. We haven't been in AI, but we still outperform because of that lower number of mistakes and the compounding process.
Now let's talk about, we're talking about strategy here a little bit. I'm gonna go ahead and throw your slideshow here. You're looking at high yield. When you're saying high yield, I mean, most people think about high yield and they immediately go, well, that's risk, right? That's a risky company, or that's a risky stock. I shouldn't be owning that much risk in my portfolio. So walk us through your high yield approach. How do you kind of construct your portfolios? What yield are you kind of looking for? And how do you balance that riskiness within the construction of these?
Yeah. So the first thing is I'm very selective. Some people have the philosophy, especially higher yield investors, they're like, oh, I'll just buy almost every high yield I can find, and maybe we'll have a portfolio with 50 stocks in there or even 100, and just the sheer diversification will balance it out. Perhaps that could work, although I think if your target is total returns, you're probably setting yourself up for disappointment. I tend to focus more on a 20 to 25 holdings at a time, maybe even 18, just depending on market conditions. So 18 to 25 at a time in my core/international portfolio strategy. I found that to be the kind of, especially if I diversify by industry, that's kind of the magic number, to have sufficient diversification so that you're not putting all your eggs in one basket or two baskets, but at the same time, being able to invest in high enough conviction, high quality, high yield opportunities to be able to limit the exposure to some of these landmines and get outperformance. Because you're right, with high yield, you're only going to be able to find only so many high quality, sustainable high yields at a time. And so you really don't want to spread your net too far there. And then, as you can see on the slide, I really have a 5-part filter then to come to these high conviction, high quality, high yield opportunities. So for example, first of all, obviously when I filter, I do want to have a high enough yield. And so typically, my overall portfolio target yield is around 6 to 7, typically around 7%. Sometimes it's 8%, sometimes it's 6%, but 7 is typically where the target is. Just depends again on where the market is, the opportunities, interest rates, et cetera. But where at least I'm getting at least half, but ideally more, of my 10 to 12% baseline total return from high yield, and then obviously I try to get that to 15 to 20 through capital recycling. So I got to filter for a high enough yield. Typically, if it's below 4%, I won't look at it. But ideally, again, I target 4, 5, 6, 7, 8, 9, and even 10%, 11% in some cases. Then I look at the valuation. Is it undervalued? Obviously, different metrics for different sectors determine that. It doesn't have a durable and defensive business model. Now, I've found that there are different types of stocks. Obviously, some are highly cyclical. Some are much more stable and cash flowing. So I typically make sure that the vast majority of my opportunities I invest in have durable defensive business models. So think, infrastructure companies like MLPs, utilities, and then there are other just infrastructure plays out there that have long duration, contracted cash flows, regulated assets, maybe leases on real estate from REITs, et cetera, or even they invest in loans like BDCs, again, contracted cash flows, versus cyclicals, which I do typically have some exposure to those as well, because those can be massive home runs, but timing is everything with those. So I try to wait and still pick ones that have very strong balance sheets, which is my next point, so that they can weather prolonged down cycles, and also try to buy when they are in a down cycle so that the yield is higher, the market is gloomy. So then when it recovers, we get a big win. I recently had one like that, Delek US Holdings, where we were buying it on the down cycle late last year into this year, and it has rocketed higher. It's been a huge winner for us. So that's an example of that. We've also had some losers on that front, like LyondellBasell. I bought it when it was already in the down cycle, but turns out it's had a historically long down cycle, and so it's gone down even further. So, you win and lose with the cyclicals. That's why I try to keep them to a smaller number. And I still try to end up ahead with those, with the vast majority of my portfolio is that stable cash flowing kind. But all of them, I insist on having strong balance sheets, so you don't end up with stuff like NextEra Energy Partners that lures you in with an attractive yield, maybe even has a defensive business model, but the balance sheet undermined it there, and the dividend got even completely eliminated. And then I want a well-covered payout, obviously. If it's not earning enough in cash flow to cover the distribution, it's pretty hard for it to be sustainable. So while I think the balance sheet is often more important in the long-term sustainability of a distribution and really the total return story, sufficiently covering it with a nice margin of safety is also important, because then you get into situations like, there have been many like this, like Easterly Government Properties recently did this, WP Carey did this a little while ago, where when you have a prolonged high cost of capital environment, especially REITs, but other sectors as well that have razor thin coverage ratios will often cut the dividend, even if they don't have to, simply because they want to free up more cash flow to invest in growth opportunities. And then finally, I want to make sure that my income stream can keep up with inflation over time. So either it needs to have an extra high yield, like for example, a BDC that yields 10 or 11%, or even there's some MLPs and REITs that yield that much, or it needs to be I have to have a high conviction that its payout is going to grow at a rate that meets or beats inflation over time. And so those are really the filters that I look at. If the company passes all those filters, it's definitely on my my watch list / short list. And then it just comes down to a matter of comparing to other opportunities at the time, how much capital I have available. I'll often interview the management team. Obviously pour across the earnings calls, everything, all the information I can get, read other articles on Seeking Alpha and elsewhere to get more in-depth research, make sure I'm not overlooking anything, learn about the industry, peers, et cetera. And if I have confidence in the management, I like their strategy and everything, I'll typically buy a position.
So let's go back here to number one, because you mentioned attractive valuation. The metrics that you're looking at, what do you like to focus on when you approach these companies?
Yeah, it really depends. Obviously, valuation, there are many ways to look at it. One that's pretty simple is just look at the yield plus the expected, conservative estimate of growth moving forward, because the thought is that, if the company's, earnings per share or whatever equivalent of it, especially if it's dividend per share, increases at a certain rate, and the market holds that at its current yield or valuation multiple, plus the yield it's paying out, then that is an easy estimate of the total return. And I don't lean entirely on that, obviously, because it's overly simplified. But if, for example, it trades at a material discount to its recent historical average valuation multiple and the conservative estimate of growth plus the yield, and I think the yield is sustainable, gets me into double-digit territory, and I like it, checks all the other boxes, that's a pretty good, it gives me a good feeling about that I'm not overpaying for the stock, with a long-term view. But I look at many other metrics, like, for example, with BDCs and REITs, I look at price to net asset value. That's another good way to look at it. Obviously, price to earnings, price to AFFO, price to distributable earnings, price to distributable cash flow, enterprise value to EBITDA is a good one to look at with, for example, midstream companies, doing discounted cash flow valuation models. You can look at the PEG ratio, especially if it's more of a growth-oriented company. So there are all sorts of models. It really depends on the industry and the sector. I don't really have enough time on this call to go a deep dive into that, but those are some of the models that I look at.
All right, Samuel, let's go ahead and switch over here. Let's start talking about MLPs. MLPs is kind of what we've mentioned. You're going to give us two names today. Midstream. Why do you like Midstream so much?
Yeah, and well, first of all, just you'll see these reasons here are somewhat similar to the slide you just saw in terms of my filters. In general, I find it to be the sector that best checks all my boxes that I just talked about previously. But specifically, midstream is one of the highest yielding sectors today as a whole. If you look at sector ETFs like the Illyrian MLP ETF, for example, has around an 8% trailing 12-month dividend yield. You compare that to non-leveraged, and again, that's non-leveraged. So if you compare it to non-leveraged, utilities ETFs, non-leveraged REIT ETFs, it's about twice, or in some cases even more than twice, the yield that you're going to get from those. Sure, BDCs still have them beat, mortgage REITs have them beat, but I think that midstream yield is more sustainable than those, and I'll get into that in a minute. But I also think the valuations are still very attractive, whether you're looking at enterprise value EBITDA based on its historical norms, still very attractive. If you look at it on a yield plus projected growth of the distribution, excuse me, just got it. Sorry about that. You're getting a very strong profile there of yield plus growth. If you look at it on a discounted cash flow valuation basis, it's very attractive. And then especially when you combine it with these, next several points, the durable defensive business model, midstream, the typical midstream has between, 80 and say 95% of its EBITDA exposure coming from long duration contracted cash flows or even regulated assets in some cases, which makes them even more conservative, more defensive. And so they tend to have very low commodity price exposure, which in an industry like energy is invaluable because energy can be so volatile. So it makes them much more of a defensive and durable business than a cyclical business, which is, the energy producing companies are more cyclical in nature. And so that makes them more dependable as income machines and also much easier to value. And then, of course, their balance sheets have become very strong in recent years. I think especially around, between the 2018 energy crisis, and you had the likes of like Kinder Morgan slashing their dividends. The model was really broken for the industry where in the past they were just issuing equity very aggressively, having to really depend on capital markets. But when the energy industry crashed and some big names like Kinder Morgan really crashed their dividends, that really broke the market's confidence. And so then they had to pivot to, okay, we're going to have to self-fund our growth. And COVID further emphasized that with the crash in energy prices and the real emergence of the ESG movement. Since then it's run out of some steam, but for a couple of years there, the ESG movement was really taking off. And so they really shifted to the self-funding model, which resulted in very low leverage ratios, strong investment-grade credit ratings, and a lot of free cash flow generation. And so that's also led to very well-covered payouts. It's very rare to see a midstream that has razor-thin distribution coverage. And so that also gives a lot of confidence in the sustainability. Despite the payouts being so high in terms of yield, they're still very well covered. And then finally, there's very strong distribution growth because of that large amount of free cash flow they're generating, and they're still generating solid underlying growth. They're able to grow their payouts at rates that easily beat inflation. In fact, some cases double-digit per year growth. And then also they're big macro tailwinds. They are good inflation hedges because energy tends to do well in inflation, and they have inflation indexation in many of their contracts. And also we have the AI boom going on, which in the United States, is driving increased demand for natural gas, for example, to power data centers. So a lot of midstreams have natural gas infrastructure, and in certain cases, it's very well located to profit from this trend. And then finally, there's the NGL boom. A lot of countries, whether they be in Europe, South Korea, Japan, Taiwan, and even others in Asia, potentially even China, if a trade deal is struck, they're wanting to import more U.S. energy. And so these companies have a lot of export terminals and NGL infrastructure that's fueling this and attractive growth opportunities. So when you put all that together, sure, no investment is risk-free, but I just see it as the most complete package of any sector if you're looking at high yield, but also wanting to minimize risk and maximize total returns.
Now, I wanted to ask you, so I'm looking at the crude oil futures here. It's $63.49 right now. Is there any worry about the price of oil continuing to go down and how it affects the midstream sector?
Sure. I mean, I would agree that if energy prices drop, it's certainly going to affect the unit prices in the near term, the stock prices of midstream companies, because they're in the energy sector. And so generally, the market trades them in line with the energy sector. They're often not as volatile. And also, generally, it does not impact their cash flows very much. If you look at some of the leading blue chip midstreams during 2020, for example, when energy prices completely crashed, the economy ground to a halt, most of them showed very minimal or even in some cases continued to grow their EBITDA through that cycle. And so they're generally pretty commodity price resistant. The scenario I'd be more concerned about was if energy really crashed hard for an extended period of time. Because most of these midstreams, they have diversified counterparty exposure and or they have investment grade counterparties. And so even if energy prices are down for a bit, they have mission critical assets that's contracted with long term, take or pay type stuff, minimum volume commitments. So that really doesn't affect them in the near term. It's only if it's for the long term when recontracting comes up that it could hurt them. But again, they're diversified enough. They have high quality counterparties. Their contracts are typically pretty long duration, such that it's really not a big deal. Again, a $62 barrel is not going to affect demand for their pipelines at all. It's more if it got down to say, in the 40s or below for a sustained period of time, that it would be more of a concern.
Gotcha. Thanks for clarifying that. So before we jump into some Q&A, obviously we have these two picks. I want to dive into these and hear your reasoning behind them. And then we'll go over the Seeking Alpha platform and jump around and look at valuations and stuff. But let's go ahead and talk about these. You brought these two names. Let's kick off with OKE and then we'll follow up with MPLX. What is it you like about these specific two?
Yeah, so first of all, I picked one that's a C corporation and one that's an MLP. And I did that because I know that, for example, non-US investors or people who want to invest in an IRA, or some people who just don't like to deal with K1 headache, they can only exclusively invest in C corporations because they issue 1099 tax forms. Whereas others, like myself, do really like K1s because you can invest in a taxable account but get your distributions classified as return on capital. And so it makes it a very tax efficient form of income that further, benefits you in terms of a total return, after tax total return perspective. And then you can save your 401k or your IRA funds for other opportunities, other investments. And so you get a better overall tax treatment of your portfolio. But that's, why I picked each of these. And I think that OKE, for example, is my favorite C corporation midstream right now. It's a blue chip. Not only is it have a strong investment grade credit rating, its leverage ratio is coming down. It's probably going to hit its target level this next year. And so it's well diversified pretty much across the midstream value chain. And so it has a lot of qualitative strength to it, but it also is very attractively priced compared to peers, as you probably can see on that chart there. The prices come down a lot. Now, I think it got way ahead of itself when it got over $100 a share, but I think, low to mid 70s is too cheap. The yield is around 6% on a forward-looking basis. It has an EV to EBITDA in the 9 point something times range, whereas a lot of its C corporation peers that are of similar quality, like Kinder Morgan, Enbridge, TC Energy, the Williams companies, et cetera, those all have double-digit EV/EBITDAs, even up to 12 times. So there's a huge EV to EBITDA disconnect there. And again, OKE is not some low-quality company. In addition to its strong balance sheet, it has, again, well-diversified portfolio. It has the former Magellan Midstream Partners, MNP, for those of you who remember it, that it had acquired. That's high-quality refined products portfolio. It also has very strong, high-quality natural gas and NGL assets. It's investing aggressively in those, gets the majority of its cash flows from those. And so, it also has the data center and the energy export tailwinds stories supporting it. Highly contracted cash flows, only about 10% or even slightly less than that exposure to commodity price risk. So again, a lot of qualitative strengths going for it. You got the yield, you got the low EV to EBITDA valuation multiple compared to peers. It's retaining over 50% of its distributable cash flow. So very strong coverage ratio of its dividends. So its dividends should be very safe, should grow at a rate that meets or beats inflation. It has all that extra cash flow that it's using to continue to pay down debt to reach its target leverage ratio and further strengthen its balance sheet, and to invest in growth projects. And so, I expect it to generate a mid to high single digits growth rate on a distributable cash flow per share basis for the foreseeable future, combining with that 6% yield, and what I think is a compelling case for valuation multiple expansion, all underpinned by a strong balance sheet and a defensive business model. I think the risk reward there is very attractive, especially relative to other C corporations that tend to be quite expensive.
That's awesome. Thanks for walking us through this one. Interesting indeed. Let's jump over to MPLX now. That was the second one that you brought.
Yeah. So MPLX, as I said, obviously issues a K1 tax form, which, again, it's for some, not for others, but I like it a lot because, and to be clear, there are other K1s that I like a lot as well in the MLP space, but MPLX really sticks out because it has such strong distribution growth. It's been growing at this past year at 12.5%. It hiked its distribution, and management has indicated on recent earnings calls that it expects to grow at a very similar rate for the next several years at least. And meanwhile, despite that really high growth rate, you think, okay, well, it probably has a low yield. Well, actually, its yield is, if you look at it on a next 12-month basis, it's actually pretty close to 8%, well above 7%. So you're getting a really high yield plus a really high distribution growth rate, which just creates a very powerful total return scenario. On top of that, MPLX has been buying back units. They continue to believe their units are undervalued. So there's a lot like there. Its EV to EBITDA is around the same as OKE's, 9 point something. But what also is great about MPLX is it has a strong balance sheet, a very low leverage ratio, a strong investment grade credit rating, well laddered debt maturities, generates a lot of free cash flow. It also has low commodity price exposure. Management is leaning very heavily into its natural gas type investments. It's also doing a joint export joint venture with OKE, actually, on the ONEOK, interestingly enough. So it's leaning into these, the NGL terminal plus the natural gas growth stories, really emphasizing that part of its business, again, which provides it with attractive growth potential over the long term. And that's, to me, really what makes MPLX set apart, because you compare it to a peer like Energy Transfer and even Enterprise Products Partners. And to be clear, I like those as well, and there are different reasons to like different ones. But what amazes me about MPLX is that they've been able to grow their EBITDA, and while growing their distribution very aggressively compared to those other peers, yet keeping their leverage down, and just delivering phenomenal and buying back a lot of units and just delivering overall phenomenal returns. And the only way they're able to do this is because they generate really high returns on invested capital in their projects. And that's really their secret sauce. And they continue to do that really well. And that's what enables them to do all these things at once. Whereas if you look, for example, Energy Transfer, they generate one of the lowest returns on invested capital in the space. And so they're retaining tons of cash flow, but they're not really growing at the same rate that MPLX is, even though MPLX retains less cash flow. And so that, to me, is really, MPLX clearly has a really good management team. They really have a good set of assets, and they know how to leverage them well to really deliver this best of all worlds, so to speak, to investors. And so that's why I'm pretty excited about MPLX.
Yeah, this is looks like it has a nice dividend growth history as well. So quick question for you about in the midstream space. I mean, we're seeing more and more mergers and acquisitions popping up, or these companies, are they selling off assets? Are they buying assets? Like, are they going full throttle from the, you mentioned you talked to management teams within the sector as well. I mean, what is kind of like the inside look within how they're approaching this, call this economic slowdown potentially?
Yeah.
Aggressive, or are they kind of steady Eddie? Maybe we'll sell off this, buy this. We'll invest in new growth, but financially smart because they don't know what's coming next, for example.
Yeah. So first of all, just a quick context. You'll see on that dividend growth history chart, 2021, the bump there that go up.
Yeah.
Yeah, right there. You see that little bump there. That's just because they paid out a special distribution that year on top of their regular. So that's why there's the little loop there. It's not like they hiked it and then had to cut it. It was just a special distribution. Anyway, just for those who may be confused by that. But yeah, back to your question. It really depends on the midstream. In general, there's a consolidation trend going on. For example, as I mentioned, ONEOK in recent years, they've acquired several different companies. Energy Transfer has done that as well. And then there are others who make more strategic, small-sized bolt-on acquisitions, including, Plains All American Pipeline has done that. Western Midstream has been doing that. Energy Transfer has been doing that. MPLX has been doing that to a lesser extent. But I would say, in general, the trend is still heavily towards strategic growth opportunities where they can unlock, and it could be small bolt-on acquisitions as well, just wherever they can find significant synergy. So typically, there's not a fire sale going on in the sector. Valuations are pretty respectable in the private market. So pretty much acquisitions or bolt-on growth projects or small bolt-on acquisitions are pretty much being exclusively targeted at places where significant synergies can be found. That assets that can mix in well with their existing asset footprint, where they can cut costs, realize synergies, and generate profits that way. That way, the seller walks away happy with getting a fair market price, and the buyer walks away, and they can then recycle that capital into a more synergistic opportunity, and the buyer also is happy. That's really what's happening there. And then, of course, I expect in the next several years, when you combine the more deregulatory pro-energy policies of the current administration with the reshoring of American industry, or at least that's the hope. And then, of course, the AI boom again that's expected with data center buildouts. I expect for even more growth projects to come up for a lot of these companies, especially ones that have well-positioned natural gas and NGL infrastructure to take advantage of. Also, again, these trade deals with export opportunities. So I expect the organic growth side of things, especially with these strong balance sheets and significant cash flows, to pursue. But no, there's no one that's just recklessly going full bore. Even Energy Transfer, which is probably the most aggressive in the space, they learned a hard lesson in 2020 when they got over got ahead of themselves with growth investments. The rug was pulled out from under them with the energy market, and they had to cut their distribution in half. They're still growing aggressively, but they're being more, I'd say, more reasonable about it.
Good to hear. Good to hear. Well, always like management that actually sounds like they know what they're doing. But everyone, I want to take a quick moment. If you like what you're hearing from Samuel, if you want to learn more about his model portfolios, I want to highly encourage you, go check out High Yield Investor. I'm going to go ahead and drop the link here in the chat. And if you're watching the replay, the link is below this video. Samuel's running a nice introductory offer, 20% off the price for right now for a limited time if you sign up within, I think it's the next week or so, 2 weeks. But go check out his analysis there. I mean, it's incredible. You have the entire community there as well, and you're always constantly putting out updates. So can't thank you enough for that. But just wanted to go ahead and plug that for everybody. Now, I want to get into some of these questions that people are asking because there seem to be a few that are reoccurring. So we're going to get into some, not so much MLP stuff, but there was a question here about mortgage REITs. Is that a sector that you like to invest in, or is that one of your, don't fly zones?
Yeah, I have made one investment in the past in a preferred stock for a mortgage REIT, and I do invest in a ETF that does have some mortgage REIT preferreds in it. But it would be very, very hard for me to buy an actual common equity in the mortgage REIT unless it was just a very, very unique circumstance. And the reason for that is simply there's just too many landmines in that sector, too many dividend cuts. The overall sector has dramatically underperformed over time. And so you really need to be a specialist who's really, trading actively in the sector. And that alone, really, I think, to have a chance of really getting any value add. And so for me, again, I try to focus on places where I think the odds are much more in my favor. And that's, again, it's a financial engineering exercise where you're just hoping to play the interest rate spread game and hoping that your underwriting performance is really good to be able to do anything. And people can do that for short periods. You can make a lot of money in short periods of time with mortgage REITs because they end up being leveraged bets on interest rate movements. But for a longer term perspective, it's much harder to make money. And I like to invest in things that, as Warren Buffett says, if the market closed for 5 years, I wouldn't panic. I'd be happy holding what I have.
Robert over here in the chat wants to know what you think of closed-end funds. Any thoughts?
Yeah, I do think about closed-end funds. We typically do a deep dive on some of my favorite ones and least favorite ones in the moment each quarter at High Yield Investor. I have invested in a few. I'd say my biggest concern with closed-end funds is the leverage. A lot of them put out a lot of leverage that can really expose them to downside risk in the event of an epic market crash. For example, the 2020 COVID crisis, I remember there was a Midstream CEF that looked really good. It had all the top names in there. It had a really good yield. It was trading at a big discount to NAV, but it also used about 30% leverage. And when the energy market crashed and MLPs crashed, the fund had margin calls come in. And not only did it lock in a lot of losses, the fund actually had to shut down because it just lost too much of its value. And so investors got hit very hard with that one. So again, I don't think CEFs are all bad. You just have to be very selective. Make sure you're buying at a discount to NAV, because that's kind of the whole point of buying CEFs versus ETFs, because you pay higher fees for them. So at least get a good discount to NAV. Watch the leverage very carefully. And then also watch the distributions. Many CEFs distribute cash that they don't generate from underlying dividends. They just return your principal to you. And that puts you on a pretty unsustainable income footing. So if you're depending on CES for income, you really need to be careful about those things. It's easy to just see a big yield and think you're good. But it's usually a much more complicated story than that. So I'm not averse to CEFs, but I'm very, very highly selective. And it has to meet a pretty high threshold for me to actually want to buy one.
Yeah, leverage will get you. Steve here wants to know, do you use a deep approach within your 3 model portfolios, or you collect the cash and then reinvest it opportunistically?
Yeah, so I collect the cash and reinvest it opportunistically.
Okay. Let's see here. What is your highest, lowest average yield across your 3 portfolios that you have?
Well, I'd have to check right at this very moment. I don't have it in front of me because the market fluctuates. But like I said, almost, for example, my retirement portfolio, which the primary goal there is durable high income, and then total returns is a secondary goal. There it is. It pretty much has to yield at least 5% for me to want to add it. But most of my holdings in that portfolio, again, because I have a lot of preferreds, baby bonds, regular bonds, a couple ETFs. Occasionally, I'll put a CEF in there, and then obviously some high yield blue chip stocks. But most stocks in that portfolio yield 6 to 10%. But again, if it's 10%, it's got to be, it's a very, very unique animal. Because I want it to be sustainable and grow at a rate that meets or beats inflation. So typically they're like in the 6, 7, 8, with a couple that reach 9% range there. My core and international, I'm a little bit more flexible on the downside in terms of yield because total returns are the primary goal, but I still want a very high weighted average yield. So, the portfolio weighted average yield is still in the 6 to 8% range. Typically, it needs to be at least 4% though, still for me to look at it. The only exception I'll make is if either I buy a stock at 4 to 5% and then it appreciates a bunch and it dips below that, but I still think the value is good. Or a couple times I bought some gold miners that, earlier this year, for example, when gold was way ahead of gold miners, and I saw a lot of really good opportunities. I was buying some gold miners like Newmont, Barrick Gold, B2 Gold. They were only yielding around 2% or so at the time, but I saw incredible upside potential. So I bought those in my core and international portfolios, and the results have spoken for themselves since then. And members aren't complaining. But yeah, that's like the only time I would ever dip below 4% for a stock. And again, the yields can be up to 11, 12% in those portfolios as well.
All right. So we had a question come in here wanting to know your thoughts about covered call ETFs and the selling of those calls for obviously income.
Yeah, I've written a good number of articles about those actually on my public profile, especially the high yield investor profile. So I encourage you to look at those for more. But, and I know it's very divisive. Typically, those articles get the most heavy-hitted opposition in the comments. And I get it. A lot of retirees like those funds. And so they feel, again, they see things different from me. And so I can see that. My issue with covered call ETFs in general is one, you pay a higher fee. Obviously, it makes sense. They're doing a service for you. They're not just holding a portfolio. They're implementing an additional strategy there. So I get the higher fee, but they do charge a higher fee, which over the long term, as Warren Buffett says, performance comes, performance goes, fees are forever. And so unless there's, a truly, dynamic, alpha generating strategy that I see at play, if a skilled active manager running a concentrated portfolio knows what he's doing, like a Warren Buffett. If it's just it's kind of an index fund type strategy and we just blindly overlay covered calls on it, I'm not a big fan of paying a high fee for that. Now, if it's an actively managed portfolio where they're intelligently, based on valuation and market dynamics, et cetera, selling calls, okay, I can get behind that strategy potentially a little more. Again, I want to look at it, see the manager's track record. But in general, again, I don't like paying the higher fees. The covered calls, it's been shown typically end up eroding NAV over the long term because you're capping upside while still getting yourself full downside in market crashes. And so, again, I think the only time I'd really want a covered call strategy, other than if it's, some manager who's actively managing it and I believe in his strategy, if it's more of a passive thing like a JEPQ, for example, or even a QQQI, which are, semi-active, but mostly passive, rules-based type funds, is, as a high yield investor, it's hard to find tech stocks, for example, that have high yields. And so maybe you want portfolio diversification. I got it. So maybe you want to have, 10% of your portfolio or 15% or 5% or whatever allocated to one or more of those types of funds just to give you better diversification while still getting that yield. I don't think there's any harm in that. Personally, I don't do that. If I want tech exposure, I'll buy a low cost ETF like SCHG or some other fund like that doesn't sell calls because my goal is I want to generate enough income for my dividend stocks that are going to grow, et cetera. So why pay an extra fee for income that I don't need when I could just get a lower cost growth fund that will actually outperform over the long term? But again, I don't think you're crazy if you have, say, 5 to 15% in a fund like JPQ or QQQI or something similar because you want the tech exposure, but you still need the income. But again, just as I'm going to have my whole portfolio in these or even a very large percentage of it, I don't think that's a very prudent strategy.
All right. We got a question here from Adrian. Says, any comment on MPLX's dividend ratio payout being so high?
Yeah, so that's something important when it's important when you're investing in midstreams, and really a lot of the companies that I cover is you can't use GAAP metrics because there's like accounting depreciation and all this other kind of stuff that goes into it that can skew the gap numbers. So for example, MPLX, when you want to evaluate their payout ratio, you actually want to look at the distributable cash flow, or you could even look at their free cash flow perhaps. So for example, with their distributable cash flow, their coverage ratio is about 1.5 times. So that's, a payout ratio of, about 2/3. And so, that should give you a better picture of how sustainable their distribution is. And especially when coupled with their strong balance sheet, et cetera, it's actually on much stronger footing than, say, the gap earnings per share payout ratio indicates.
All right, we got a question here. Would you consider ETFs such as for the BDC space? Let's start with that. Yeah, BDC, because you talked about BDCs earlier in the conversation here today. Would you kind of go towards an ETF for that, or would you rather just buy the individual stocks?
It really depends on the timing, the market dynamics. Right now, and in general, I don't favor the BDC ETFs. And the reason for that is simply because, for example, if you look at BIZD, which is a very popular one, it's market cap weighted. And so it's like the top few BDCs dominate that index anyway. And then you're paying a fee for the ETF. So it's like, why not just buy those individual BDCs to begin with? You're going to get a very similar performance and save on the fees. It's not like they generate K1s that are, a pain to deal with. And also, BDCs already charge management fees, especially if it's an externally managed BDC. And so why would I want extra fees on top of that? On top of that, right now, especially, I see a lot of inefficiency in the BDC space. There are some macro headwinds. There are signs the economy may be fraying. Some are bullish on the economy. Again, it just depends on your politics and your views of the Trump administration's policies. But we're not going to get into that here. But regardless, you can make a case for a bullish outlook or a bearish outlook on the economy. I think there are lots of merits to both. But there is some risk of that, and we also know the Fed is likely going to be cutting rates aggressively in the near term, or at least start to cut somewhat in the near term. And that's going to put pressure on BDCs because they invest in short-term floating rate loans, and as opposed to long-term interest rates. These are short-term interest rates, and so when the Fed cuts rates, that directly correlates with their income. Meanwhile, some of their loans are long-term oriented in nature, and long-term end of the curve has actually been rising due to inflation concerns, et cetera, and bond market problems. And so that's kind of an unfavorable balance for BDCs. So I'd be highly selective. And even despite those headwinds, you have most of the blue chips like Main Street Capital, Aris Capital Corporation, Blackstone Secured Lending, and so forth, all trading at very expensive valuations relative to their historic norms. But I do think there are some opportunities in the space where you can still get a high quality BDC that is trading at a large discount to its NAV. And so, I'm very underweight BDCs, but I am selectively buying some just for the sake of diversification and where I see opportunities.
All right. So Lee asked here and obviously I should have asked you this earlier because sometimes I forget that not everybody knows everything, right? Can you elaborate on the pros and cons of a K1 versus a C Corp in a tax deferred account? There's some people here that don't understand the tax differences.
Okay, so I'm not a tax advisor, not a tax expert, so I generally steer clear of these types of questions, but I'll just share from my own experience so basically if you hold a K1 in a IRA, I thought you said tax deferred account, so say a standard IRA or a Roth, you put yourself at risk of paying what they call UBTI tax. And that's basically, a K1 issuing securities. Not all do, but most of them generate UBTI. Again, this is my understanding of it. And so that can cause you to have to pay tax on those gains. Whereas if you held it outside of an IRA, it doesn't generate that UBTI, and you don't have to pay tax on those gains. It just becomes, you still pay capital gains tax and everything if you sell the stock, the units, but you're not basically diluting the benefit of your IRA because you're not holding it in your IRA. In addition, sometimes the UBTI tax rates can be higher than your normal tax rates if held in a taxable account. Again, it just depends on your circumstances. Whereas C Corporation does not generate UBTI if held in an IRA or 401k, and so therefore you don't have to worry about paying any UBTI on it.
Yeah, and just reiterate, you're not a tax advisor. If you have questions, please go seek out a tax advisor.
Yeah, I would encourage you to do your own research. That's just my opinion off the top of my head. So,
yeah. All right, let's go back into your portfolios here. So there was a question here about talking about your international portfolio we're talking about with all the assets in there. How do you balance across many sectors with so few asset types in some of those?
Yeah, I mean, again, like I mentioned at the beginning, it's a fine balance between investing what you're convicted in, but at the same time being humble enough to realize that, COVID could strike at any time, or a war could break out, or you could just be flat out wrong. And so I try to, like I said, that's why I still have some BDC exposure, even though in general I'm not like ultra bullish on the sector. Or, I love precious metal. I've been very bullish on precious metals the past several years. I've done very well with it, but I haven't gone all in because I realized, that my thesis could be wrong. Events are very unpredictable. Midstream, I've liked that a lot coming out of COVID. I've done very well with that too. But again, I haven't gone all in on that because I'm trying to be somewhat balanced. I've been somewhat concerned about REITs too because the higher for longer interest rate environment. So I've been very underweight that, but I still own some. And, I've actually done pretty well with the REIT picks that I've had. So, you just got to be, it's a matter of, diversifying across sectors, but then within those sectors, I try to pick only my highest conviction names. And I found that that's a good balance because then you have the macro tailwinds kind of balanced out, but you're investing consistently where you see value and quality and yield all intersecting. And, also obviously with some growth there as well. And so in aggregate, sure, I'm going to get some losers, like LyondellBasell has been a loser for me. I've run into a macro buzzsaw, but even then LyondellBasell has dramatically outperformed its peers. Like Dow Industrial, for example, has dramatically underperformed LYB. So even there, yeah, it's a loser, but it's not losing as much as if I was just going into the broader sector. And so I'm reducing my losses incrementally. I'm outperforming with some of my picks in areas as well. And so in aggregate, it's helped fuel our outperformance while still having that good diversification across sectors.
There's a great question here asking about your retirement portfolio. Is that portfolio focused for people, future retirees, people planning for retirement, or is that more focused for people in retirement already seeking that yield?
Yeah, again, I'd say it depends on the person, but what your goals are. But what I would say is the retirement portfolio is focused on its primary goal is maximizing durable income, and so it's low risk income. So it's basically the stock has to have a yield that I think has a low risk of being cut, and within that atmosphere, and reasonable diversification, I try to maximize the yield that it generates within those safeguards. So that again, if your focus is passive income, you're not as concerned necessarily about total returns, and you want to mitigate risk. That's the portfolio to look for, which naturally suits retirees better than a younger person. Whereas the core and international, they still, still have an attractive yield that they throw off, but they're willing to take on extra risk in order to pursue higher total returns. So better suits someone like me, for example.
Thanks for clarifying. Ronald wants to know, do you recommend to wait for pullbacks to rebuy with your dividends that you get paid, or do you just buy at any time?
I mean, and that's the beauty of being diversified, right? There are almost always opportunities out there. There's almost always a place that's out of favor, and there are almost always places that are in favor. And so I don't chase things higher. I don't like, oh, I've got to buy something right now because I've got cash. But it's very rare that I'm not seeing an attractive opportunity to buy. And I just, some people, they worry about volatility, like, oh, I'm not going to buy a stock until I see a catalyst for it to go higher, or I'm going to flee from a stock because it's got negative momentum. And instead, I try to invert it, and I let volatility serve me rather than me serving volatility. And by that, I mean, I know Mr. Market's going to have constantly changing moods, changing emotions. And so I let him decide. He'll tell me when it's a good time to buy a stock or when it's a good time to sell a stock. I'll let him tell me. When he decides to offer me a really good price for one of my stocks, I'll sell it. I'll gladly sell it to him. I'm not married to any single stock. If he decides he wants to offer me a really good deal on a stock, I'll gladly buy it from him. And that's how I view my dividend reinvestment plan as well.
All right. There was a question here about dividend payout frequency. So within your portfolios, obviously, I'm sure you have names that change over and stuff, but if you had to guess, I guess at this point, how many of them are set on a quarterly dividend payout versus like the REIT sector paying out those monthly payments?
I'd say the vast majority are quarterly, but what you need, and I have a few months, but what I would say is to remember is that they don't all pay on the same months, right? So the effect is that I have every month, I have a lot of cash flow coming in because the quarterly schedules, are not exactly in sync. And so one month, maybe I'll have, 6 stocks that are quarterly will pay a dividend. Next month, I'll have 6 different stocks that pay quarterly, pay a dividend, so on and so forth. So the net effect is that I have, pretty stable monthly income stream coming in.
Do you have like an average period of time that stock is held in your portfolios, or I mean, I'm just asking about trading frequency, right? Are you holding for a year? Are you holding for 5 years? Or is some in and out? Do you have any?
Yeah, my buy and sell decisions, as I mentioned earlier, are 100% dictated by Mr. Market. So I don't have a set commitment to a thing. And obviously, everyone's tax situations are different. I have people joining constantly, and so I can't just say, "Oh, well, we're gonna wait," And I hold most of my securities in a Roth IRA. So again, the tax ramification is not significant. But yeah, I would say in general, it's prudent if, say, you're at 11 months and maybe your stock has reached or exceeded your fair value. Sure, it's probably, and you have a big gain. Yeah, it's probably a good idea to wait an extra month so you get the long-term rate instead of the short-term rate. But again, it just depends on your tax situation. Maybe you have another big loss you're selling to offset it too, so it doesn't even matter. That's all, everyone. I would encourage you to just do your own decisions, but certainly take, if you're in a taxable account, take those into consideration. But in terms of how I run the service and how I run my own portfolio, again, because it's almost all in a Roth, is I just let Mr. Market dictate it based on the valuation. So I'm happy to sell a stock after 1 week. I'm happy to sell. I mean, I've had a holding recently, Papa John's. I bought it in the 30s, and within a couple of weeks, it was over $50 a share, and it hit my fair value target, and so I gladly sold it. I only held it for a few weeks, and a lot of members were like, "Oh man, like I didn't even get a chance to buy it." I was like, "Yeah, I wanted to buy more too, but I just market didn't give me that chance." But then I've had stocks that I've held since the very beginning of our launch at High Yield Investor, because it just goes up gradually, and the intrinsic value increases gradually, and it's just a steady long-term compounder. So I'm not, I buy a stock typically almost always the case that I'm happy to hold it for forever, as long as the thesis remains intact. But I'm not like, oh, I have to hold it for a certain amount of time before I'll sell
Smiling over here, Randall just chatted in. Who is Mr. Market? Can I have his phone number? I wish we all wish.
it. Amen. Yeah, he's a pretty elusive guy.
He treats you sometimes. He gives you nice little layups every once in a while. All right, everybody, let's go ahead and wrap it up here. Samuel, thank you so much for answering all these questions. I know I just blasted you with like a ton of them here, but everybody is very, very interested. Everyone, high yield investor, Samuel Smith, he's the leader over there. As you mentioned, you heard his history about joining Seeking Alpha, writing, and now he runs this service. He does have that 20% discount going on for a limited time right now. So if you're watching this replay a month from now, unfortunately, you won't be able to grab it. But if you watch today, or if you're watching the replay as soon as we release it, go check out his service. Can't recommend it enough. Samuel, I'm going to give you the floor for a second. Anything you want to share before we jump off?
Yeah, I did want to mention too that I'm planning to hold a webinar for members of High Yield Investor in a couple of weeks, where you guys can ask me any questions you want live. I also have the chat there where I definitely try to reply within 24 hours unless I'm traveling, in which case I put out a note. But I try to be responsive to both. You can send me private messages. You can set up a personal call with me too. I do that for members. But again, the webinar, if you enjoyed this format, again, I'll be offering one for members here in a couple of weeks as well. Otherwise, great talking to you all this morning, and I enjoyed this, Daniel. Thank you.
I gotta say, I appreciate personally how dedicated you are to your so keep it up, and we'll do this again here soon. But everyone, thank you so much for tuning in, and I hope you have a great rest of the trading week. Stay careful out there, and we'll see you in the next webinar. Take care.